Welcome back to Investing Talk Podcasts.
Today we're looking at Circle Internet Group.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. The core idea here, the main thesis, is actually pretty straightforward.
Okay.
It all centers on one thing. This company is showing massive, and I mean massive, operating leverage, and it's almost all being driven by the scale of their main product, USDC.
Right, operating leverage. So for anyone listening, that just means as the business grows, the costs don't really keep up, right? So profits grow way faster.
Exactly. And the Q3 2025 numbers, well, they really show this in action. It was an exceptional quarter. It really shifted how the institutions see them.
They absolutely did. I was looking at the financials. The top line was just stunning.
It was. Total revenue and, this is the crucial part, the reserve income hit $740 million just in Q3.
And that's a 66% increase from the same time last year.
Yes. But you have to look under the hood, at the engine behind it, the asset base. USDC circulation didn't just grow. Well, it's sort of to $73.7 billion.
Which is, what, 108% year over year?
108%. The velocity of that growth is just, it's almost unprecedented. I mean, think about it. The asset base nearly doubled in just 12 months.
But that's always the question with rapid growth, right? Is it sustainable? Or is it a growth at any cost? How did that translate to the actual, the bottom line?
It translated directly. We're talking a major profitability surge. Net income jumped a staggering 202% year over year.
Wow.
It hit $214 million. This is the clearest proof you'll find of that operating leverage. They scaled reserves over 100%, but their fixed costs barely move, so all that passive income, it just falls right to the bottom line.
And what really tells the story, for me at least, was the surprise factor. I mean, analysts are paid to be sharp, and they just completely missed how fast this was happening.
They did. The consensus expectation for earnings per share for Q3 was only 20 cents.
And the company came in and reported, what was it, 64 cents?
64 cents. That's more than a triple beat. I mean, a gap like that between Wall Street's guess and the reality, it tells you everything about their current momentum.
It suggests the market was just dramatically underestimating how powerful that reserve income engine really is.
And if you connect this to the bigger picture, it really confirms the business is healthy. It's moving from that heavy investment phase into, a massive cash generation phase.
Right.
Gross profit is stabilizing near 54% for 2025. But the number I keep looking at is the adjusted EBITDA margin.
And what are you seeing there that gives you that confidence?
It's the potential expansion. The margin could expand to around 22% as the stablecoin keeps scaling. That expansion is the operational leverage. Once the platform is built, the cost to manage the next billion is tiny.
So as the asset base goes past, say, 80 or 90 billion, the margins should just get wider and wider.
Exactly. And we're seeing it happen in real time. This isn't theoretical anymore.
And they're building all of this on an incredibly solid foundation, financially speaking. I think people get so focused on the growth numbers, they sometimes miss the balance sheet.
Absolutely. They have a fortress balance sheet. The total debt-to-equity ratio it's negligible, 0.05. It's basically a debt-free company, especially for its size.
And over $1 billion in cash.
Over $1 billion in cash and equivalents. So they're completely self-funding their own growth. That's critical. And they're not doing buybacks, no dividends.
Which tells you management sees a lot more road ahead. They're putting every dollar back into the business to lock in that market dominance. Okay, so let's unpack this a bit. The financials are obviously robust. The product is scaling like crazy. So what about competition? What stops some big tech firm or another crypto player from just launching their own stablecoin and eating their lunch? What's the moat here?
And that's where we move beyond just the numbers, into their structural advantage. The primary moat isn't some secret tech. It's the network effect that USDC has built. That and its regulatory position.
So even though it's the second biggest stablecoin,
its real value, its stickiness, comes from being so deeply integrated everywhere.
It's like trying to switch from an iPhone to an Android. The phone itself is one thing, but the real pain is moving all your apps, your data, your entire workflow.
That is the perfect analogy for stablecoins.
Right.
For USDC, that network means it's built into hundreds of DeFi protocols, all the major global exchanges, these specialized payment networks. They've all spent years building their infrastructure around USDC. Those are incredibly high switching costs.
So a competitor can't just replicate that network overnight.
They can't. And that trust in the network leads right into their second big advantage, the regulatory side of things. And that's what really separates them from the current market leader.
You mean Tether?
Exactly. Unlike some others, this company has been all about financial audits and transparent reporting from day one. That compliance, it's expensive, it's a headache, but now it's paying off in a huge way.
Because regulators globally are starting to get serious.
They are. We're seeing countries like Japan start to mandate specific reserve and audit rules, and those rules heavily, heavily favor an audited, compliant asset like USDC. So as regulators tighten the screws, this proactive compliance becomes a massive competitive edge. It's a barrier to entry.
And here's where it gets, for me, really interesting. They aren't just a one-trick pony. If they only relied on reserve income, they'd be totally at the mercy of the Fed. But they're branching out. I'm thinking about their tokenized asset product, USYC.
Yes. The success of USYC is a phenomenal signal for the future. For those of you who aren't familiar, USYC essentially tokenizes traditional assets like short-term U.S. government debt. It's basically a digital T-bill.
And it's growing fast.
200% growth recently. It just crossed $1 billion in assets.
Wow.
And that signals two things. One, their tech can handle complex real-world assets. And two, institutional demand for tokenized finance is accelerating way beyond just digital dollars. It proves their platform can be a bridge for traditional finance.
And this all plays perfectly into the broader macro environment we're seeing right now.
It certainly does. I mean, potential Fed rate cuts, ironically, might slightly reduce some reserve income, but they'll also fuel a broader rotation back into the crypto space.
Right. Lower rates push investors toward riskier assets, and they need a safe on-ramp.
A compliant, secure on-ramp. Exactly. So you have this confluence of great internal execution and favorable external factors. It just sets them up exceptionally well.
It really seems like the market is starting to recognize this. Let's pivot for a second and look at the technicals, the investor sentiment. The stock has seen some pretty strong moves lately.
We've definitely seen that shift. There was a sharp 9.8% surge recently, right after some new partnership announcements. And if you look at the charts, you're seeing consistent higher highs moving up steadily since the IPO.
And analyst consensus seems to be building aggressively around this story.
Absolutely. The targets from the big research houses are, well, they're highly aggressive. Bernstein is targeting $230, and Wells Fargo is targeting $128. The consensus is sitting around $141, which signals really strong institutional confidence. For investors looking at the charts, that 75 to 88 DI range, it really looks like a strong support zone now. Institutions seem to be buying the dips.
But we should add some nuance here. The technicals aren't all flashing green, are they? You mentioned some mixed signals.
That's right. It's important to look for conflicting data. While the stock is generally in an accumulation phase, some momentum indicators, like the MACD, have actually been showing bearish readings.
Meaning the stock is going up, but the speed of that move is lagging behind.
Exactly. And for those of you listening, when you get this conflict, strong fundamentals clashing with lagging momentum, it often creates what we call a hidden bullish divergence. The market just hasn't fully priced in the fundamental shift yet.
So the colossal EPS beat, the nonstop USDC growth. The fundamentals are pushing the price up, even if the short-term indicators haven't caught up.
Precisely. The market is slowly waking up to the reality of that profit power. And that 9.8% single-day move suggests the smart money is starting to flow in fast.
Okay, we've hit the great earnings, the competitive vote, the bullish setup. Now we have to talk about the risks, the bear case. What are the big red flags an investor needs to be watching?
The first one that jumps out immediately is insider selling. It's been pretty notable recently. We're talking about $56 million worth of shares sold over the last 90 days.
That's a huge number, almost 700,000 shares. And heavy insider selling always makes people nervous. So what's the context here? Are insiders losing faith, or is it something else?
It's often just noise, but you have to scrutinize it. A lot of this selling lines up with vesting schedules, tax obligations, especially for a company not long after its market debut. Executives have to sell shares just to cover the taxes.
And you have to balance that against who's buying them.
Yeah, right. You have to. While some insiders are selling, institutions are actively buying more. Firms like Huntley Advisors, Larson Financial, they've been building up their positions. If the company were really in trouble, you'd see the smart money heading for the exits, not buying more.
That's a crucial distinction. Okay, let's go back to profitability. We talked about the great adjusted EBITDA, but you mentioned that on a GAAP basis, the EBIT margin is still lagging.
And that's the second key risk, maybe the most important one for the bears. The reported EBIT margin is still negative, sitting at negative 12.1%, and operating expenses rose 70% year over year. Management has been very open about raising guidance for OPEX to between $495 and $510 million for the year. They are spending heavily.
So where is $500 million in spending going? Why tolerate a negative EBIT margin?
It's a strategic investment blitz. It's all about long-term regulatory capture and global licensing. That money is going to specialized talent, to securing licenses in every major jurisdiction, and to massive investments in security and auditing.
So they're taking that huge reserve income and just immediately reinvesting it to solidify their lead.
Exactly. They are choosing growth and market dominance over short-term GAAP profitability. The negative EBIT isn't a sign of failure. It's a strategic choice to spend from a position of strength to lock in that future 22% EBITDA margin.
So turning to the forward look, for someone following this story, what are the key catalysts to watch?
The next big one is the Q4 2025 earnings report. That's expected in early February 2026. That's our next data point on this whole operational leverage story.
And consensus is already building around their raised guidance, which should give investors some confidence. They didn't just meet expectations, they totally changed them.
They did. They raised guidance for other revenue, so non-reserve income like USYC, to between $90 and $100 million. All signs point toward continued fundamental strength.
So to wrap this whole investment thesis up, what's the final word?
The core strength is just undeniable. You have the USDC network effect driving massive financial growth, plus that aggressive reinvestment. It positions the company perfectly for a potential technical breakout as institutional confidence keeps growing. Given the leverage and the unique regulatory tailwinds, the current valuation really suggests a multi-year hold is warranted here.
It's a fascinating balance they're striking, isn't it?
Yeah.
Using the solid, predictable income from USDC reserves to fund the more innovative, high-growth areas like tokenized assets. That dual-engine strategy seems to be the core of it all.
It is.
I guess the key question for investors now is how much of the global market can they actually capture before governments or central banks roll out their own digital currencies?
Indeed. The long-term game isn't just about competing with other stablecoins, it's about becoming the indispensable, regulated plumbing for digital dollars globally, and whether they can set themselves up to work alongside central bank digital currencies, or if they'll be in conflict with them. That's the ultimate question for the whole sector.
For more in-depth investment analysis like this, make sure you subscribe. We'll see you next time.